Let's say how you would do it.
Well, the issue is basically, what is your economic forecast and why? And as I've said the last time I was on the show a couple of months ago, I think that stagnation, which has been driven largely over the last 5 to 10 years by a gradual encroachment of entitlement spending on gross domestic savings. And entitlements are rising because they're mandated, and gross domestic savings is the residual of what is left over, and the data are unequivocal on this, that the sum of the two are flat, meaning their entitlements are crowding out the gross domestic savings. But gross domestic savings, along with the amount of savings we borrow from abroad, is what gross domestic investment is. And gross domestic investment, plus some educational issues, is the key factor in productivity growth. And productivity growth is the key factor in overall economic growth. So I'm reasonably short-term optimistic, largely because I think the tax cut is in the right place, mainly in the corporate sector. But I find the longer-term outlook rather dismal.
And Chairman Greenspan, it's David Faber. You've discussed this before, in particular, of course, entitlements. You mentioned it's been a couple of months since we've spoken to you. And on the same topic, but a bit apart from it, deficits. I'm curious to get your take. Given the tax cut, the deficit will be generating, which we have a better sense of now, and, of course, the budget deal as well, which is adding to that deficit, particularly given what you said about what is mandated spending on entitlements. Is it a concern, a growing concern for you? And will it crowd out others as well when it comes to the bond market?
Absolutely. And I think that's the main problem that we have when disregarding that the real problem is not monetary policy. That's going to run itself. And the Fed is fairly sophisticated in all the increments involved, and especially the new chairman. But what it isn't the case is the longer-term outlook for the budget deficit, which is downright scary. And budget deficits inevitably engender some introduction of an acceleration of money supply and price level expand. In other words, inflation is going to enter into the stagnation, and as I've been arguing for a long time, we are already moving into stagflation, which actually feels better than stagnation because, for example, profit margins are moving up. The data for January are not too bad. And actually, if you look at the overall outlook, short term, you're beginning to see the effects of the substantial cut in the corporate tax rate. Remember, the corporate tax rate is the critical issue in this tax cut. The other elements of it are really secondary. But this is an extraordinary effort because the last time it has been done was Ireland. Ireland had very much the same 3.5% marginal upper tax rate, and they brought it all the way down, cut it in half, more than that. And the result was an acceleration in productivity growth. I think that's the one positive fact that's on the agenda at the moment. But longer term, the entitlement issue is irresistible because the population is aging. An ever more larger number of entitlements are coming on stream, and that is going to make the productivity outlook very iffy, and that worries me considerably.
Fed Chairman Greenspan, this is Morgan Brennan. In light of the comments you just made and sort of this talk about budget deficits, I mean, we've heard a number of high-profile investors recently, Paul Tudor Jones, Ray Dalio, Bill Gross, all say that they think the bond market is a bear market. What is your take on the markets right now in light of this fiscal situation?
Well, you mean, what do I think of the markets generally?
Yes.
Yeah, well, I would say we are in a bond market bubble. And a bond market bubble merely means that prices are too high. And when they move down, long-term interest rates move up. And if you take a look at the structure of not price-earnings ratios, but earnings-price ratios in the stock market, you find that the critical issue of what engendered some of the strength in the recent period is essentially the decline in real long-term interest rates as it's factored into the market. That is in the process of changing. And I think that the bond market bubble is now beginning to unwind, and that is going to bring us ultimately into a state of stagflation. And beyond that, it's very difficult to tell. This is not an easy economic outlook because there are too many variables which we haven't seen in recent decades.
Right. One final variable we want to ask you about. People have gone back and looked at Powell's transcripts in some meetings back in 2012. He was a little bit less convinced than some of his colleagues that quantitative tightening would be smooth. And we're a month away or so from going to $90 billion a quarter. Some worry if it's going to no longer be like watching paint dry. What do you think?
I'm not quite. I don't really have a real opinion on that. What specific part of that do you want me to comment on?
I guess do you anticipate any noticeable effects on ancillary markets, equities, for example?
Well, of course. I mean, if real long-term interest rates go up and you're in the process of having, it's inevitable that the effect on stock prices is negative. In fact, that's one of the really major factors determining equity price ratios. And therefore, as real long-term interest rates rise, stock prices fall. And I'm not saying what we're looking at in the last few weeks is meaningful. But remember, the last few weeks, I think, are responding to the good part of the tax cut. Before I got into government, I was on a lot of corporate boards in which I had to sit through preparations of capital investment expenditure processes. And what struck me all the time is when they got down to the issue, the very end of it, you had what's the pre-tax rate of return on this investment and what is the after-tax return. And the after-tax return is a clean cut. And so when you're going down from a 35% marginal rate to 21%, that's impact on prospective investments, which is exceptionally high in a marginal sense. So I, on the one hand, in the short term, think the capital goods markets will be okay, but longer term, productivity is in for serious diminution.
That certainly rhymes with what we're hearing out of quarterly conference calls. We're not going to get to talk to you next week on your birthday, but happy birthday in advance.
If you have been curious how to make the money when markets fall, please visit marketcrash.money and get some additional information. Specifically, I have compiled some interesting reasons why stock market crash 2010 is a definite possibility, why we could be going for another Bitcoin crash, and more importantly, how to not let the market crash or the Bitcoin crash take advantage of you. Find out how to profit. If you're a new trader or an experienced trader, but you're looking for new ideas, new ways, how to take advantage of the market fall. Because quite honestly, markets do fall much, much faster than they go up. So it represents, for a trader, a great opportunity to profit on the opposite direction of the market in a much shorter time frame and oftentimes maximize much bigger returns. So if interested in knowing the ways how I trade weekly options for huge profits as much as 3,800% to 5,000% on certain days, get in touch with me. Visit this link right here, How to Profit, read some information, and schedule your consultation. I'll be glad to help out and get somebody on the right track and show you some of my profitable ideas and share some experience which I've accumulated over the last 30 years trading weekly options. Thanks for watching. I hope this was helpful. We'll see you soon.